Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, July 25th, and you're tuned in to the state of the stock market. We're going to go through the breadth tables. We got a new signal from mid-caps. We'll look at the sector breadth table, which is unequivocally bullish. And we've got healthcare coming to a potential make or break level. And the same goes for the biotech ETFs as they test their breakouts. And we need to watch those two closely. So the purpose of this State of the Market report, which is weekly, is to tell us if we want to be bullish on the stock market. And when we're bullish, that means we're looking for pullbacks and we're viewing those as opportunities. We're looking for relative strength, maybe if we're running a momentum portfolio, or we're looking for bullish setups in the form of flags and wedges and triangles and what have you. And we're ignoring bearish setups, and that's a very important thing to remember. And I use the S&P 500 as my main barometer for the stock market simply because it accounts for like 80% of the total investable U.S. stock market. It is the 800-pound gorilla in the room, or the 80% gorilla, however you want to call it. And so what we have here is the S&P 500 hitting another new all-time high. Now, that is expected because we've been in an uptrend and the bulk of the evidence has been net bullish since the middle part of February here. And then we got the 20-day moving above the 200-day there in March. We got the pullback to this support zone here and the 200-day in late May, early June. And then we got a little breakout there in June and a move to new highs. And once again, we're up 10% from those lows there in early June. Now, maybe we're extended, maybe we're right for a pullback. I'm not going to try and predict a pullback when the bigger trend is up, because the bigger trend is a dominant force at work. All right, what we want to look for is we want to look for stocks that are setting up, and that is in harmony with the bigger uptrend, setting up bullish. So let's break down the market and look at the breadth indicators that told us to be bullish on the 15th of February. So I used 3 different breadth indicators applied to 3 indexes to get a broad assessment of the health of the overall stock market. Now keep in mind, the S&P 500, if it is healthy, then I cannot be bearish on the stock market, even if small caps are net bearish, which they still are. But large caps are still bullish, and that's the most important thing. Now, the first group of indicators measures the breadth thrust, a bullish breadth thrust or a bearish breadth thrust. And we're using the 10-day EMA of AD%, advances minus declines divided by the total issues for each of these 3 indexes. And you can see that we got a move above 30% in early January in all 3. That showed extremely strong buying pressure across the board. That's kind of like a rocket lifting off. You get that upward thrust that gives you enough velocity to escape the pull of gravity and continue higher. So that was the earliest signal when all 3 of these triggered. So the next indicator group is high-low percent, and that shows me the percentage of stocks in each index that is in a strong uptrend or a strong downtrend. Because if you're hitting a 52-week high, you're in a strong uptrend. No ifs, ands, or buts about it. If you're hitting a 52-week low, you're in a strong downtrend. Now, I'm not going to worry about divergences here, or say if we're getting a little bit of lagging. I want to see a move above plus 10%. Like we got here in February for the S&P 500 high-low percent. All right, that shows enough critical mass in new highs, strong uptrends to support a bull market. And you can see this indicator stays bullish until we get a move below minus 10%, which we haven't gotten yet. Now, small caps and mid caps were dragging their feet. They had bearish signals from October, and mid caps reversed their bearish signal in early June. So mid-caps are on an active bullish signal, and 2 of the 3 have been net bullish since June 12. And small caps have yet to reverse their signals from October and the affirming signal in December there. So this one needs to get above plus 10%. But as I said before, small caps really are small. All right, they are the tail. They are not the dog. They represent like less than 10% of the total U.S. stock market. it's the large caps that we need to be focused on, because when they start to weaken, that's when we can get a bear market that takes down everybody. The third indicator group is the percentage of stocks above the 200-day EMA, and you can see that measures trend participation. And I would like to see a move above 60% to turn bullish and a move below 40% to turn bearish. I don't use that 50% line because you get too many whipsaws. You need to put your bullish threshold just above and your bearish threshold just below. And in fact, I find that a good process for lots of indicators. Say MACD, all right, you want it to get a certain amount above its signal line. You don't want to take the initial signal line cross, let it move above a little bit to get some distance from that signal. So if we look at this indicator here, you can see that we were net bullish in February when we had all three on bullish signals, but then we had small caps flip to bearish in March and mid caps flip to bearish in May. So two of the three were bearish in May, at the end of May, but mid caps have flipped back to bullish with a move above 60% this week. So mid caps are getting into the groove here and finding some animal spirits. So now let's put all these indicators, all 9 of them, on a table to get our weight of the evidence approach. So here's the breadth table that is summing up these signals. And with the new signal in mid caps, there you can see percent above 200-day EMA signaling on July 23rd. We now have 6 or 7 of the 9 indicators on active bullish signals. So all 3 indicators are bullish for large caps and mid caps. And you can see 2 of the 3 have been bullish for mid caps since June 7th. And we can see that small caps are still net bearish. But as I'll show a little bit later, IWM is catching a bid and getting a breakout that we should pay attention to. All right, now let's turn to the sectors, and I do use these same indicators on the 11 sectors, and then I put them together in a table to show me how the S&P 500 is doing, because the sector stocks are also part of the S&P 500. There are no sector SPDR stocks that are part of the S&P Mid Cap 400 or S&P Small Cap 600. But again, what we're looking for is a breadth thrust, and you can see here that we have the 10-day EMA of 80%, and we got a breadth thrust there in April. And we've got high-low percent. We got that move above plus 10% in March. And the first signal was that move above 60% in the percentage of stocks above the 200-day in early February. So if we look at how the signals added up, we can see by March that 2 of the 3 were on active bullish signals. This one, percentage above the 200-day EMA, and the high-low percent indicator. The 10-day EMA of 80% was on a bearish signal, but that reversed in April. So by April, all 3 were on bullish signals. But I just go for a simple weight of the evidence. 2 of the 3 were bullish. And then I've got the chart here with the 20-day moving average and the 200-day. I don't like to use the 200-day and price because you get too many whipsaws. There you can see a break, whereas the 20-day held there. So that's another filter you can use to assess your strength or weakness of a sector. But the reason I like to use a weight of the evidence approach to these sectors is, A, we have the breadth indicators to do it. And B, it's going to reduce the whipsaws and give you a bias based on the internal components of the sector. You're using these breadth indicators which show the internal strength or weakness in the sector. And so by getting that bias, you know which way to lean. So here we can see we get the bullish bias there in mid-March, and there was a sort of channel or wedge working there. And we got a bullish bias heading into the spring and summer, and we get another bullish channel or wedge. So we know to take these bullish signals and ignore the bearish signals. That's the most important thing you get out of this. When you have a weight of the evidence that is bullish, you need to look for bullish signals and ignore bearish signals. Now, one sector that is setting up right now is healthcare, and that is because the indicators are net bullish and the sector SPDR price is near a potential support level after a breakout. So if we look at the indicators, we can see that they were net bullish there in February. There's the line showing that. So we had the breadth thrust in January, and we had the percentage above the 200-day EMA turn bullish there in actually late January. And then we got high-low percent turning bullish. So we got a little whipsaw here with the 10-day EMA of 80%, but the other two indicators held. They didn't trigger bearish signals, so the net was still bullish. And then we got another breadth thrust in June when we got that breakout. But what's interesting here is there you can see the breakout, and we can see that broken resistance turns support, and we're testing that level. And I'm watching for a little breakout here. Maybe perhaps we have a little bit of a wedge working here. And if we get a little breakout there at 93, that's going to be a bullish development for healthcare. Now, with any strategy or signals grouping or whatever that you use, I'm looking at the weight of the evidence here. You're still going to get whipsaws, and the finance sector produced a lot of whipsaws in March in particular here. So if we go back and we look at the signals, you know, we were all net bearish when all three were on bearish signals there in October. And that stayed bearish until first we got the breadth thrust in January, and then we got the percentage of stocks above the 200-day EMA above 60% in February. So that's when we were net bullish. But then when you only have two indicators on bullish signals, well, when one flips, then the net flips. So we went to bearish, but then we got another flip there, and we went to bullish. And then we got the percentage above the 200-day flipping bearish in March, and that flipped the signal. And then again, finally, we flipped to bullish here in April. So where does that put us now? Well, we have all three indicators on active bullish signals. So we have the 10-day EMA of 80% bullish, we have high-low percent bullish, and we have the percentage of stocks above the 200-day EMA bullish. So that means we can absorb one bearish signal without flipping the group, so to speak. And so finance has been bullish since April. You can see we had that little pullback there into May, June. That was a nice opportunity. And we're breaking out here from a little consolidation. So finance is starting to lead again. So the sector table remains unequivocally bullish, and this, keep in mind, captures the 11 sectors that are part of the S&P 500. So there are a few small pockets of weakness within the S&P 500, namely energy is net bearish with two of the three signals actively bearish, and consumer discretionary never got a breadth thrust. So it's got, the last thrust was bearish in mid-May, but two of the three indicators are bullish. So the sector is net bullish. And then you see the sector weights over on the left-hand side. And so I take that weight and I multiply it by the ratio of bullish to bearish signals. And you can see that would be 3 of 3, which would be 1. So you get 100% sector weight for these sectors. And then consumer discretionary has only 2/3 bullish. So you only apply 2/3 of the weight to your bullish signal. And then you add them all up, and we're at plus 88.44%. So you can have plus 100% to minus 100%. And as long as we're well above this 50% level, the market looks just fine. It's when we get below 50% that we need to start being concerned. But right now, we're in a bull market. So on Tuesday, I highlighted a little trading strategy that used the Bollinger Band squeeze and the Arun indicators. And basically what happens is when you get the Bollinger Band width going below 5% on IWM here, and I've got MDY next, and you get the Aruns going below 50, then you have some sort of a consolidation. And the signal is to look for an Arun to surge above 50. But sometimes if you wait for the indicator to signal, you're going to miss the breakout. And you can see that's why we have to watch price action very, very closely. And if you look at this IWM chart here, you had this really nice advance, a falling wedge, and we got a breakout yesterday with a big, big candlestick. So now we can mark support here at 154 and reevaluate on a close below that level. If we look at MDY, we did get a signal. Now, the good thing about MDY is it started perking up yesterday, or the day before, actually, because you can see we got that really nice bounce there and got above that high from 2 days ago, 2 days before, and then we got a follow-through breakout, and you can see Arun turned up and broke above 50, so we hit 100. That means we got a 20-day high. So there's the previous high, and you can see we got above it to hit a 20-day high, and we broke above the upper Bollinger Band. So IWM and MDY are in bull mode, and you can use the lows from that middle latter part of July, closing lows. And if you go below, say, 352, then you have a failed signal. Now, it's really interesting when you look at IWM from a longer term perspective, because we're maybe getting a bigger breakout. So what you have here is you have this big advance, because you did hit a higher high there in April. It's kind of a, maybe the advance ended in February and you've kind of been working your way lower. But I think overall there's a big advance and some sort of corrective decline. And I used some shaded trend lines there to mark a general decline there. And you can see we're breaking out of that little general decline. We haven't gotten above that high, but this could be a bigger breakout in the making that signals a continuation of that January, February, March move, and we could see an assault on the prior highs. And if we look at RSI, we had a bearish failure swing in play since March, but now we're breaking above 60. So RSI is also getting some sort of momentum breakout. So again, this is bullish price action in small caps. And if you go below that low there, then we have a failure. All right, now I want to run through some ETFs, and I want to focus on the leaders. All right, so when we're in a bull market environment, I think it's important to focus on the leaders. Sure, there are going to be leadership changes, but to tell you the truth, I don't know when they're going to happen. Right now, we're seeing leadership coming from the finance sector and banks over the past month or so. But if you look at banks and the finance sector over the past year, they're still not really leaders. Now, if we look at ITB, the home construction iShares, it's still in an uptrend. You got the initial breakout, a pullback, another move higher, and then we've kind of just been working our way higher. And I don't want to read too much into this consolidation, but we still got higher highs and higher lows. So I think ITB is still in bull mode and could be poised to bounce within this rising consolidation. And you can see RSI is holding that 40 to 50 zone and remains in that 40 to 80 zone, which is the bull zone for momentum. Now, here's a real leader. All right, a real leader is hitting a 52-week high. Here is cyber. This is the NASDAQ Cybersecurity ETF. And I highlighted it here. You had the pullback and you hit that reversal alert zone, broken resistance, turning into support. You retraced 38 to 50%, and then we got the breakout. And I marked this support zone here, and I'll show it on these next charts, that as long as this green zone held, the breakout was valid and we had no reason to question it. All right, we got to accept what is until it isn't. And this is what is, or was, and we're hitting a new 52-week high. Now we're getting extended here. And if you see here back in February, we got extended there, but the advance continued for over a month. Now I'm not predicting that, but what I'm saying is overbought is more a neutral signal than it is a bearish signal. It just tells you that maybe it's a little too late to participate in the uptrend, but it's clearly, when you're overbought, it's more bullish than bearish because it takes strong buying pressure to become overbought. Now, if we look at hack, it is not as strong as cyber, and that's for the simple reason that there's the high and we're still below that high. Now, hack is not weak because hack has the breakout working there. There's the green zone that defines the validity of the breakout, and it held the breakout zone and continued higher. So this one's still in bull mode. It's clearly technology where I'm finding most of the leaders, because you break out the technology sector and you can see that these individual tech-related ETFs are leading. Here is the FinTech ETF, and we can see it broke out to a new high in the early part of June and is hitting new highs. So it's clearly a leader. The First Trust Internet ETF hit a new high last week. It's below the new high, but it did move above that high from late April. So it's clearly a leader. And again, we had the breakout, and the breakout held. So we're kind of in a monitoring phase because we had the signal in June, the breakout there, and now we're just monitoring for signs of a pullback and looking for the next opportunity. Here's the iPay, the Pure Funds Mobile Payments ETF. And when the market was making lower lows from May to early June, iPay was making a higher low, relative chart strength. And iPay had a new 52-week high in early June, and it just continues higher. So this is one of, if not the strongest ETF out there right now as far as I'm concerned. And there are the stocks. You can see Visa, MasterCard, PayPal, Fiserv, all doing very well. Semiconductors catching a big bid yesterday with a 3% advance. And you say, oh my God, a 52-week high. That is extraordinarily bullish. Well, I think the real bullish signal was this reversal alert zone and breakout in late May. And the problem I have with the advance now is you've been moving higher, and then you get this outsized 3% advance after a move from 74 to 92. So you go from 74 to 92, and then you surge 3%. Often when you get these big moves after an extended move, it's more the beginning of the end or the beginning of a pullback than it is the signal that we're going to accelerate higher. Now, I'm not predicting a pullback. The trend is up, and we definitely want to have XSD on our radar for a potential bullish setup in the coming weeks. Now we look at the semiconductor ETF SOX. It too hit a 52-week high, so that is a bullish sign for the broader market. Software also hitting a 52-week high actually last week there. But again, there we have the breakout, and the breakout held. So we're doing okay. And this is like a little consolidation and a move higher. And this is the weakest one in the tech group. It would be Sky or cloud computing. You had the breakout, but then we moved below the breakout zone that I set. So technically it failed, and then it whipsawed. But that's going to happen. And it looks like we have a little bit of a flag working here. And maybe we get a breakout from that flag and continue higher for cloud computing. Now, in yesterday's Don't Ignore This chart, I featured Biomarin and I featured IBB and XBI as well because, if you look at it on the face of it, biotechs are one of the weaker groups in the stock market right now because we all know that the S&P 500 is hitting a new high. So we can see that the IBB remains well below that August-September high, and it didn't even come up to that February-March high during this bounce in June. So that in and of itself tells us that biotechs are underperforming. Now, even though I don't see relative strength, I do see this bullish reversal alert zone still in play and a potential firming at the breakout zone. And so, biotechs, I think, are kind of the ones you don't want to buy at the highs, really. You want to look for that reversal as soon as you can catch it because they can get away from you real quick. So if I look at IBB here, and also keep in mind, I showed you the healthcare SPDR, and healthcare is still net bullish. Medical devices is by far the strongest group within healthcare. And we're seeing some uptrends in Merck as well. Abbott is performing well. But biotechs as a whole have really been dragging their feet. But if we look at this chart and we look at the reversal alert zone, we can see a couple things. First of all, there is the reversal alert zone. What happens is you have a big advance that looks like a impulse move. And an impulse move is like the primary trend. If it's up, then an impulse move is bullish, tells you're in a primary uptrend. So the second thing we get is what looks like a corrective move. And we got a falling wedge, which is typical for a correction. We came to that 50 to 62% retracement zone, which is typical. 2 steps forward, 1 step backward. And we started to firm here in that 100, 102 area. So everything was coming together, and this was highlighted before the breakout because I like to do these things before the breakout. And then we got a really nice breakout. All right, so what now? Well, we've got the breakout, and even though the breakout hasn't failed, we haven't got much follow through because, it looked like we were going to continue higher there in June, but we fell back here in July. But look what we got here. We've got resistance turning into support, and I'll move to a straight line here. So we have a broken resistance zone there turning into support. If you put your Fibonacci retracements, this is going to be about a 50 to 62% retracement. So we're going a bit micro, if you will. When we did this one, we had a bigger reversal alert zone. And now I'm only focusing on this piece right here. So again, we had the big surge, the pullback, and the pullback is near broken resistance turning support. We're support here from that low and this low, and we're firming. And if we can get a breakout there at 107, I think that's going to be a bullish development for biotechs. That's something we really need to be watching because that could happen any day now. Of course, we could go below 104, and I think then that would negate this breakout that we saw here in June. Now, if we look at XBI, XBI is actually holding up better than IBB. So what we have here is a similar situation in that you have the big advance, you have the corrective move defined by the falling wedge, you retraced around 50%, firmed, and then we got the breakout. And so now if we just focus on the smaller portion from June to July, what we can see here is that we have broken resistance turning into support, and we're firming at that level. Look how flat IBB has traded in that 85 level. There's a lot of firming going on, and if you want to mark resistance for a breakout, you can do it right there at 87.5. Need to go back to my straight line. My pointer is not playing nice here. There's that resistance level at 87.5, and a breakout there would be quite bullish because it would mean this bigger breakout held, and we're continuing on this breakout here from June and this big move up earlier in the year. So I think biotechs really need to be watched closely here. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and have a great day.